Hello and welcome to our first financial market commentary of 2019. It's set to be an eventful year for investors, and there'll be a lot of volatility along the way. And in fact, I think investors will be hoping that they've got an umbrella like the lady that you might recognize from our boardroom. What do we think is going to impact on financial markets this year? Well, there are a number of themes that are swirling around and creating very negative sentiment. Nevertheless, the encouraging thing is that there are some bright rays of sunshine on the horizon. So let's start with the negative things. I've talked about US monetary policy quite a lot in the past. It remains, I think, the dominant theme. Cost of money is rising and liquidity is being reduced because of the policies currently being pursued by the US Federal Reserve. Closer to home, we of course have the uncertainty, the farce or soap opera, if you like, of Brexit. We swing from one way to the other on a daily basis. Let's face it, getting a Brexit withdrawal agreement through Parliament was always going to be a challenge. Parliament is divided because it simply reflects the electorate, which demonstrated that it is also divided given the narrowness of the vote. But as we get closer to the deadline for the withdrawal agreement, I expect that pragmatism will prevail on both sides of the negotiation. The EU is talking pretty tough at the moment, but the reality is that the EU needs a relatively smooth transition in terms of the UK's exit, because the EU generally and the Eurozone specifically is suffering an economic slowdown. The economy in France is stagnating. It looks like Germany is heading for a recession. Add to that Germany is certainly in the sights of the Trump administration in terms of their huge trade surplus with the US. Things don't look good for Europe at the moment, and the last thing politicians there need is for the economy to be worse than it otherwise might be. Moving on to China, financial markets are concerned about the rate of the slowdown in the Chinese economy, and at the same time there is an awful lot of debt in China. Much of their economic expansion has been fueled by debt, much of which is not government debt, but actually corporate debt. I think in the round, the key thing that should provide some reassurance is that the Chinese authorities retain the financial firepower to keep things on an even keel should there be an upset in their debt markets. But certainly we need to be aware of what's happening in China and understand how their pathway is going to change as they migrate from a low-cost, low-skilled economy to a much higher-cost, higher-skilled economy with a much wealthier domestic consumer. So thinking about China and its relationship with the US, well, certainly the trade dispute or trade war is a topical issue and has had quite a big effect on financial market sentiment. But again, it does pay for both sides to be pragmatic in the long term. And whilst they'll talk tough, the reality, I suspect, is that a deal will be reached. Not least for the Chinese authorities to agree to be a little less aggressive in stealing US intellectual property. Now, one of the big factors in terms of that dynamic is what is happening to the large technology companies in the US. If we think of the 5 biggest technology companies, so I'm talking about Apple, Amazon, Alphabet, which owns Google, Facebook, Microsoft. The aggregate value of just those 5 companies is something like a third greater than the GDP of the whole of the UK. So they have enormous influence, and it's important that that influence is countered so that the UK economy is not disadvantaged. So whilst our politicians occupy themselves with debating the fine detail of a withdrawal from the EU, important decisions that can help protect UK business are not being made. Now, you could argue that the US should regulate those 5 technology businesses to control their influence and power. And if you look back into history, say the 1920s and Standard Oil, that's exactly what the US authorities did. But this time is different because the US is engaged in a long-term struggle for superpower status in the digital world. And that struggle, of course, is with China. So I don't see them breaking up or reining back the influence of those huge technology entities anytime soon, because they're more concerned about losing the race against China. So back to the UK, our politicians should be focusing more of their effort, more of their time on trying to protect UK industry. The high street is embattled, it's starting to die before our eyes, and what we need is a level playing field. The reality is that if you're a retail premises, your costs are very high. You pay very high rates, high rents, cost of employment is high, taxes are high. And therefore it's almost impossible to compete with a technology company that doesn't have to bear those huge costs. So to sum up, yes, of course there are some storm clouds overhead, but I think if we look to the horizon, we can anticipate better weather. Things are going to improve in due course, and some of the negativity that currently persists will seem overdone when we look back with the benefit of hindsight. So for 2019, investors should expect a bumpy ride, but I think we'll need the umbrella a little less than currently anticipated. And when we get to the end of the year, I'm very confident that those investors that persevere will be appropriately rewarded. So that's all for this edition of our Market Bulletin, and I look forward to giving you an update next month. In the meantime, take care. Goodbye.